All right, today we're going to tackle a huge piece of the investment world, bonds. And don't worry, we're going to skip all the complicated jargon. We're just going to break down what they are, how they work, and maybe why they could be a really important part of your financial game plan.
So let me ask you this. How can you, just one person, lend money to a huge company or even to an entire country, to help them fund their biggest projects? Well, the answer is probably way simpler than you think. It's all about something called a bond.
Okay, so what is a bond really? Like, if we just strip away all the fancy financial talk, what are we actually looking at here? What's the core idea?
The textbook definition is pretty straightforward. A bond is basically a formal IOU. You, the investor, are lending your cash to a big organization. Could be a government, could be a company. And they're promising to pay you back in full after a certain amount of time.
And honestly, this is the main thing to remember. If you don't remember anything else, just remember this. A bond is just a loan. Simple as that. But the cool part is, you're not the borrower, you're the lender. You get to be the bank.
Okay, so we've established a bond is just a loan. So how does it actually work? What are the moving parts of this whole deal? Let's get into the mechanics.
You can really break it down into 3 simple steps. First, there's the loan itself. That's called the principal. Second, you get regular interest payments along the way. These are often called coupon payments, which is kind of a fun throwback to the old days when you literally clip a physical coupon off a paper bond to get your interest. And finally, number 3, you get the payback. At the very end of the loan term, on what's called the maturity date, you get your original investment back.
And this is what really makes bonds different. All the key terms are set in stone right from the start. You know the exact amount of the loan, you know the exact interest rate you're going to get, and you know the exact date you'll get your money back. That level of predictability, well, it's a completely different world from the wild ride of the stock market. It's why so many people look to bonds for stability.
All right, so if you're the lender, who's on the other side of the deal? Who are the borrowers that are issuing these bonds? Let's meet them.
Generally, they fall into 2 big groups. On one hand, you've got governments. We're talking everyone from the federal government all the way down to your local city. They issue bonds to pay for huge public projects, things like building new highways, new schools, or maybe funding a new green energy initiative. Then, on the other hand, you have companies. They issue corporate bonds to raise money to grow their business, maybe build a new factory, develop a new product, or just to help pay the bills.
Right, so that's why they want your money. But let's flip this around. What's in it for you? Why would an investor like you choose to buy a bond in the first place? What's the payoff?
Well, it really boils down to 3 main reasons. First off, you get that steady income, those interest payments showing up like clockwork. Second, it's a great way to diversify your investments. Bonds and stocks often move in different directions, so when the stock market gets a little crazy, bonds can act as a cushion. And third, they're often seen as a safe haven, a stable place to keep your money when the economy feels a bit shaky.
And this quote really nails it. At the end of the day, it's all about creating balance in your financial life. While you might have other investments that are all about high-octane growth, bonds are really designed to be that steady, reliable foundation.
But of course, no investment is perfect, right? It's super important to understand the other side of the coin. So let's talk about the risks and what you really need to watch out for.
Yeah, it's true. Generally speaking, bonds are considered lower risk. If you think of stocks as a flashy race car with the potential for huge speed and big crashes, bonds are more like the reliable family sedan. Their prices just don't tend to bounce around as much.
But, and this is a huge but, lower risk does not mean zero risk. That's probably the most important thing to get about any so-called safe investment. They are not risk-free.
There are really 2 main risks you need to have on your radar. First up, you've got what's called interest rate risk. Just imagine, say you buy a bond that pays you 2% interest. Sounds okay. But what if a year later, new bonds are coming out that pay 5%? Suddenly, your little 2% bond doesn't look so hot, does it? Its value on the open market could drop. The second one is credit risk. This one's more straightforward. It's the risk that the company or government you loaned money to, well, can't pay you back.
So at the end of the day, that's what a bond really is. It's a way to buy some stability, some predictability in a pretty unpredictable world. It's a known return on a known timeline. And that just leaves us with one final thought. In today's world, what price do you put on that kind of predictability?